back to the show, my friends. Postcards from Success, episode number 3, our first interview show, which means this is also going to be our first video show. You can find this on YouTube, and you can also find it on our Postcards from Success Facebook. I'm Thomas J. Nelson, a residential realtor and your host here in San Diego, California, where I'm never too busy for your referrals. And today's topic is 1031 exchanges and how they've been affected by the new tax laws. And because I'm going to have a 1031 exchange expert on the show today, William Exeter of Exeter 1031 Exchange Services, and I'm going to have a tax professional, Rachel Ivanovich, who owns Easy Life Management. She's an MBA and an enrolled agent, which is kind of like a turbocharged CPA. I have 2 CEOs on that are experts in their fields that are going to help shed a little light on the new tax laws as they affect 3 areas of your life. If you're a real estate professional or real estate investor, that is, you own rental property, you're going to want to know about 1031 exchanges. If you're a W-2 employee, that means you draw a paycheck and you have expenses outside of what your employer reimburses you for. That's what I'm also going to tackle with Rachel. And if you're somebody that's gone through a divorce or is planning to go through a divorce, there's some things in the new tax laws that are going to affect you come 2019 that I want you to be aware of. I'm tackling these 3 topics because I have the professionals on to do so, and these affect me personally. I am a real estate professional. I do have a bride that is a W-2 employee, and I specialize as an RCSD, Real Estate Collaborative Specialist, in divorce. So a lot of my clients that I'm helping are going through this. So that's why we're going to tackle these 3 today, because I have the right people on the show to do so. And speaking of the show, let's get on with the show. Welcome to the show, Bill Exeter and Rachel Ivanovich. Thanks for joining me on Postcards from Success. I have you both on today to discuss the 1031 exchange first and foremost. And then after that, Rachel, you and I will carry on with a couple other comments regarding how the tax law is affecting W-2 people and people going through or thinking about going through a divorce. There's a hot topic.
Indeed.
All right. So, Bill, I thought we'd get the show started by let's go back to basics. What is a 1031 exchange?
Well, the basics is it allows the investor to sell real estate and defer the payment of their capital gain taxes and their depreciation recapture taxes by reinvesting in other property. So it really allows them to dispose of an asset and keep all of their money in their pocket, working for them, building their net worth because they're reinvesting. And that's really the key. The government takes the position, you've got this asset, and as long as you remain fully invested, then they'll let you defer the taxes. If you trade down, you're going to incur some tax.
Okay. So there's a good point real quick before I bring Rachel in on this, because there's a lot of confusion with, I know with my clients, when they exchange a property, what are the limitations and what are the available properties to them? How can they dice it up?
Good question. There's a lot of confusion out there and a lot of misinformation. So people get confused when it comes to qualified use property and like-kind property. So let's start with like-kind first, because that's easy.
Okay.
Really, it means if you're selling real estate, you're buying real estate. So as long as the asset is defined as real estate, it qualifies. So lots of things would fall into that category, like certain types of oil and gas interest, water rights, air rights, mineral rights. There's a lot of, it's a very broad definition of like-kind. The qualified use is really where people get hung up, and they get hung up on, how long have you held title to the property? Was it at least a year or a year and a day or 2 years? And that really is not a requirement. The requirement is they have the intent to hold for rental investment or business use. So certainly the length of time you hold title helps prove that, but the key is if you get audited, you have to be able to prove you really had the intent to hold it for rental, investment, or business use.
Okay. So you brought up audit, so you bring in Rachel. Rachel, from your point of view as a professional tax preparer, what are you seeing with your clients in 1031 exchanges? Are they using them correctly, or are you catching people making mistakes?
As long as you're using a qualified intermediary, such as Bill and his firm, you will be in good shape.
Okay. So more or less, Bill's company or a 1031 exchange company at large is designed to help people do it the right way so they don't get in tax trouble.
Yeah, to keep them in compliance, absolutely. You
Okay.
definitely want to make sure you're working with a professional who understands what they're doing.
And Bill, I mean, I'm going to ask probably a dumb question, but I want to ask it. Is there any way people can do a 1031 exchange and not work with a 1031 exchange company? Is that even possible?
Good question. Technically, yes. I mean, you have to have someone that'll serve as the qualified intermediary. But if it's a concurrent exchange where everything's closing on the same day, you could have some of the parties involved in the transaction, serve as a qualified intermediary. Most parties don't want to do that, and so we get brought in all the time, just even on a concurrent exchange. But in theory, it's possible if you know how to structure it right.
Okay, well, and that's what I was kind of getting at, is that there is a way for people to get themselves in trouble if they don't know what they're doing. Because
very true, yes.
Okay. So
to tag on to that, if you're
Yeah.
exchanging a property that you owned in California and you're purchasing a property in another state, you absolutely need to be careful, because there's new paperwork that needs to be filed every year when you file your taxes, so that you don't disqualify your exchange.
Okay, good point. And no, Rachel, I know you have a global reach with your services. You're not limited.
You are limited, correct. You cannot do an exchange and purchase property in a foreign country.
Okay, so it is limited to the United States.
As far as I know, yes.
Okay, Bill, am I correct saying that?
Yes, well, if you're selling U.S. property, you absolutely have to exchange for other U.S. property. So it has to be domestic for domestic. It's possible to sell rental, investment, or business use property in a foreign country and do a 1031 exchange into other foreign property. So it has to be foreign for foreign. And if that would trigger a U.S. tax consequence, you could do that. And we're one of the few companies that actually will do those. So there's probably only 3 or 4 of us out there that'll do those.
Okay. And then as far as your company, Bill's reach, can you work a 1031 exchange in all 50 United States?
Yes, we cover all 50 states. We also cover the foreign properties, and then we cover the 3 territories that also qualify. So Guam, Marianas Islands, and the U.S. Virgin Islands. Okay. And Rachel, same with your tax services, you're global?
Yes, we are. Absolutely.
Okay. All right. So now the big question is, we saw some tax law changes come into effect in the fourth quarter last year that I'm assuming took effect as of the first of the year. Is that correct?
Yes.
Yes.
So, Bill, from your point of view, have you seen any kind of slowdown or confusion caused by the new laws with 1031?
No, we were relieved that they did not eliminate Section 1031. We were on the chopping block, and so that was a big risk. But they actually retained the 1031 exchange. They did eliminate the personal property aspect. So in other words, anything that is not considered real estate would no longer qualify for 1031 exchange treatment. So for example, we used to do exchanges of shipping, trucking, franchises, aircraft, machinery, equipment, things like that, and those no longer qualify. So you can only exchange real estate for real estate at this point.
Okay.
That's a small part of the business. Most of it's real estate, so we're just glad that survived.
Right. And Rachel, from your point of view, have you dealt with any confusion or problems as a result?
Absolutely not. Bill was exactly right. It's personal property that's no longer allowed. And honestly, most of my clients, when they trade in a vehicle, that's when they would come into, but you just realize any gains on the sale of a car at this point.
Okay. Now there's another question that comes up a lot with my clients, and or their plans include, we're going to 1031 exchange from Washington to San Diego. Now we're going to live in the sun. We can't wait to use it as a retirement home. Hold on, folks. What's the rule about a 1031 exchange that they're not aware of when they're making these plans?
Good question. Well, it certainly has to be qualified use, which means some type of rental, investment, or business use. Doesn't mean it has to stay that way. So if they get audited, they just have to show that was their intent, and they did in fact intend to hold it for rental purposes. You know, we're a little more conservative. We'd probably recommend 24 months, which straddles 3 tax returns.
Okay.
Then after that, the intent can change. So they can certainly decide at that point to, you know, kick the tenants out and move into it and convert it to their primary residence. But their intent, original intent, is critical. So they don't want to have the intent to live there right off the bat.
Okay. So, and Rachel, what would be the tax consequence? And that, I know that might vary depending on the individual, but in general, if somebody were to, let's just say they had the right intention, you know, but 6 months in, that rental became a necessary residence for them. Something, their house burned down or whatever, and their plans changed elsewhere, and they want to move into that rental property. Where would they get caught, and what would be the penalty?
Well, the penalty would be a disqualified exchange, meaning the entire gain would be taxable, recapture of the depreciation. But I haven't really seen that happen. If honestly, as Bill was saying, if their intent was that was truly going to be a rental property, there's not really going to be a consequence. And now they're living in their primary, as long as they can substantiate the reason why they now are living in it as their primary residence.
Okay. So then let me ask the obvious question to both of you. How do you prove intent? What does intent look like?
Facts and circumstances.
Yep, absolutely. You know, first thing we always warn them is be careful what you put in emails. Emails can be used for you or against you.
Okay.
Yes.
Gotcha. Okay. So in other words, if there was an audit or somehow they got discovered that, hey, you're living in this home in 6 months after you bought it, not 24 months or later type of thing, their realtor and their exchange company and everyone involved in that transaction could be brought in to the audit?
It's possible. Yep, absolutely.
Okay. So that's pretty clear.
Yeah, it's a case-by-case situation, and it really is based on facts and circumstances
Absolutely.
of each case.
You know, we get questions a lot about, well, I'm buying rental property. What if I get an owner-occupied loan? Does that destroy the exchange? And it's like, well, if it's truly rental property, owner-occupied loan won't hurt the exchange, but it's one red flag. It's one thing they can use against you. And if you have other things out there and that fact pattern shows your real intent was to live there, you've got some problems. So like Rachel said, it's all facts and circumstances, depends what the IRS or the state can prove. Okay,
understood. So, and then one other question that I get is, let's just say, like, here's a classic one. I've got clients moving to San Diego from the San Francisco Bay Area. They're selling a home that's worth $3 million up there, and they're coming down here, and they don't necessarily want to buy one $3 million home. Can they divide up that $3 million exchange and maybe get a single family home here worth $1 million, and then spread the other balance of the $2 million out, and they can do so in and out of the state of California all at the same time?
Sure, absolutely. Rachel, do you want to take that, or?
You go ahead.
Okay, yeah, absolutely. They could certainly identify multiple properties, acquire multiple properties. A lot of people think you have to sell one and buy one. You can sell multiple, you could buy multiple. We just have to kind of plan and trace the numbers, make sure it all works out okay. I just tell clients that the more properties involved, the more complicated the exchange gets, but it can probably be done.
Yeah, and to tag on to that, the net equity, all of the net equity needs to be rolled into the new properties. And then if you have loans on the properties, you have to replace the value of the loans. Otherwise, you may have a taxable event.
Okay, understood. So in other words, if I have $3 million worth of gain, I need to spend $3 million worth of gain or more.
And there are planning opportunities depending on if the client has suspended passive losses, capital loss carry forwards. So you definitely want to work with your tax advisor to plan if you're doing such an exchange, because there are planning opportunities that you can get some cash out on these deals.
Okay. And Bill, another question I get a lot is how long do I have to identify a property, and then how long do I have to close on that property when I'm doing an exchange?
Good question. It's all based on the close of escrow. So when the sale transaction closes, a lot of people think it's the date you sign the contract or you open escrow, but it's not. It's the closing that really triggers your deadlines. And 45 days to identify what they're going to acquire, and they've got another 135 days after that to complete their exchange for a total of 180 days.
Okay, understood.
And Bill, those are calendar days, correct?
Those are calendar days. Yep, it does not get extended for birthdays.
No holidays and weekends.
Exactly.
Okay, so that's something that people need to consider is what market are they exchanging into? What's it like? How ferocious is it as a seller's market? Or because that has a lot to do with the pressure that's going to be on them to find that next property. But the challenge being it's hard to get an offer accepted by a seller in the exchange area when your property's not in escrow yet, or at least what I'm finding is people want it in escrow and your contingencies removed with your buyer, so they know that you've got pretty much an all-in done deal, barring anything massive going wrong at that point. So one last question I have is, and this might be for both of you again, what is the most popular exchange you see, or what's the most frequent type of property that gets exchanged?
Ooh, I would say it's across the board. I mean, most the bread and butter, if you will, are single family or 1 to 4 units, because that's just the most common type of asset out there. But we do all of it. It kind of goes in cycles. We're seeing a lot more larger 1031 exchanges today, where 6 to 8 months ago, they were a lot of single family, small stuff. So it just kind of goes in waves, but it's really all out there. We do see a lot of people who are exchanging out of states like California.
Yep.
So you get a lot of that. It's hard to cash flow here in California, so they'll go to states where the cash flow is positive, things like that. And Rachel mentioned what we call the California clawback provision. So that's a key thing.
Yes.
You can expand on there. You like that nickname?
I love that. Yeah. It's very important that you make sure that proper forms are filed every single year for California, so that your exchange is not disqualified, because then the whole exchange becomes taxable.
And now whose responsibility is that? I mean, ultimately, I know it's the homeowner, but
yeah, taxpayer, but it would be important to, if you switch CPAs, or if you start working with a new CPA, that they actually know that there is this provision involved.
Okay. So would it be fair to say that somebody doing a 1031 exchange works with someone like Bill, and then Bill hands them off, hopefully, to a tax professional, and that's the sequence?
Correct.
I'd probably flip that. I would say they should get their tax professional first, because it is amazing how many times we deal with clients, and then after the exchange is done, we get more information and find out maybe the exchange wasn't appropriate. They should have done a partial exchange, like Rachel alluded to, and they would have known that had they talked to their tax professional.
Yeah, typically what I see is my client will come to me and say, I'm looking to sell my rental property. What do you think? And honestly, from 2008 through 2012, we weren't really seeing 1031 exchanges,
right?
Because a lot of people were underwater with their properties. But now I think I did about 45 this last season. So it's really becoming, and like you said, Bill, the residential rentals, the single family residential rentals have been typically the most popular I've seen. And I've been seeing people sell their residential rentals and then investing in commercial property out of state.
Well, and I would imagine too, one of the things that is motivating a lot of 1031s now is you've got equity back, and it's just sitting there. And if it can perform better by diversifying it, that makes more sense to take one large equity property and maybe spread it out across 2 or 3 and get 2 or 3 times the mailbox money.
Absolutely.
Absolutely. Okay.
Before we shift gears, Bill, I want to ask you one last question, and Rachel, you might have insight on this too. Where you mentioned people are going out of California, where are you seeing people go the most? What other states or parts of the world?
You certainly get a lot of people who go into states that have no state taxes, so Texas and Nevada and Florida and what have you. You know, it kind of remains to be seen what happens with the California clawback. A lot of people think that California clawback provision is unconstitutional.
Mm-hmm.
Once you've exchanged into a non-tax state, you know, it should be tax-free from the state level, but if somebody decides to fight that, it is what it is. And it's there, so they're still going to have to track that. We get a lot of opportunities too, where people exchange into other states. Like Tennessee is a popular one, where they can get the properties, the cash flow, etc.
Okay, good information. So, I want to shift gears and talk a little bit about a couple other changes that affect people. And Bill, I know you're a busy guy. Do you want to stay on, or do you need to take off?
I'll go ahead and drop off. If you have any other questions,
Yep.
I'll be happy to follow up with you.
All right. And what's the best way to reach out to you?
They can call, email, or go through the website. The website's got all of our contact information out there. So it's Exeter1031.com. So that's EXETER1031.com.
Excellent. All right. Bill, thanks as always for your time and your expertise. Appreciate you being on the show.
My pleasure. Thanks for having us. Take care.
All right. Take care.
Bye.
All right, Rachel, we're going to continue with a couple questions here. I want to shift gears, and this affects my bride. She's a W-2 employee, and she's a flight attendant, and she has a lot of expenses related to travel for her job. And as I understand it, starting next year, she's no longer able to deduct those expenses.
Correct, Thomas. And this was an area of concern for a lot of people when they, in December in particular, before the tax law was passed. Unreimbursed employee expenses are now no longer deductible. What I have been seeing, though, is that a lot of people who thought they were deducting these expenses actually were not deducting them, given that there was a limitation in place. And then a lot of higher income taxpayers, they were subject to AMT, the alternative minimum tax. And so because of that, they weren't able to deduct them anyway under the AMT. Keep in mind, though, if you do have unreimbursed employee expenses, there are a couple of options, one of which is to talk with your employer, see if they have an accountable plan in place, see if they'll reimburse you for your expenses, any of them. And then California does not conform with the new federal changes at all. So for California, it's business as usual. So you can continue to deduct all your expenses for California purposes, even though the Fed doesn't allow that any longer.
Okay, so those that filed or extended this year, this was their last year as a W-2 employee to
claim unreimbursed employee expenses, yes.
All right, and the other thing that a lot of people might not be aware of, and the reason I bring up divorce at the beginning of the show is because I specialize as one of my niche services in helping people make informed decisions about what to do with their home at the early stages of divorce if they are homeowners. And what people don't realize is this new tax law is going to affect divorce in 2019. Can you explain that a little bit?
Yeah, absolutely. This was a huge shocker for most of us tax professionals, and we did try to get the word out to our clients who we knew were already in that situation. So as of 2019, so 1/1/19, alimony is no longer deductible by the payer's spouse, nor is it includable in the recipient spouse's income. So this is going to affect a lot of people, and it's going to affect the decisions that people make in terms of how much they're going to be paying or willing to pay for alimony. So my opinion is it's really going to hurt the person who's receiving the income, given that people who are paying it are not going to be able to write it off anymore, and so they're going to be willing to pay. They won't be willing to pay as much.
Right. I mean, and just in plain English, and correct me if I'm wrong. So where maybe a spouse, an out spouse was normally willing to pay $4,000 a month in alimony, and we're talking about alimony, not child support, now may only be willing to offer $3,000 a month because they don't get the tax deduction anymore on that alimony.
Correct.
So obviously the ripple effect being now the house spouse, the one that's trying to keep the house, has a reduced income, and this is going to put more of a financial strain on them.
Yes.
And then and the conversation I was having with an attorney was, well, you know, the obvious, you know, won't the house spouse try to negotiate this regardless? And the attorney says, right, you can't hold the out spouse responsible for tax law changes. So they
Correct.
have a very valid reason to lower what they're willing to pay.
Absolutely. The other thing to keep in mind is that if there are any loan or any modifications to the divorce decree after January of next year, and the Tax Cuts and Jobs Act is mentioned in that modification, then the new law applies to the modification, whereas everyone else is grandfathered in under old law. So just keep that in mind, that if you do have an existing agreement in place, that you are grandfathered in under the old rules unless there's a modification and the new law is mentioned. So
Okay.
just keep that in mind.
So in other words, somebody better think really hard about taking their spouse back to court.
Correct.
Because they could open this up and they are now subject to it, allowing their spouse to lower what they might be going to get more, and they're going to end up with less than where they were to begin with.
Exactly.
Yeah, that's crazy, but
a little bit of a trap.
Yeah. And we're right now for Californians, since we have a 6-month cooling period for filing divorce, you really are looking at a deadline of no later than about mid-June this year, or your divorce isn't going to finalize before this kicks in.
Right. And keep in mind, California does not conform. So for California purposes, whoever's paying the alimony is still deducting it, and whoever's receiving it is picking it up as income. California is not conforming, as far as we know at this point, to the new federal law.
So does that mean that even into 2019,
yes,
they're going to defy that? Correct.
California is not conforming. So we're preparing 2 different returns.
Wow.
It's going to be tricky. And just like I mentioned with the un-reimbursed employee expenses, California does not conform, which means you still can write them off for California.
Okay, so then for California W-2 wage earners and California people going through a divorce, then this concern isn't a concern for them?
It's strictly for federal purposes that it's a concern.
Okay. Oh, okay. So on the federal level, yes, but on the state level, no.
Correct.
So that gets very confusing.
It's going to be very tricky.
Okay. All right. So what's your best advice? Let's stick to the divorce for a minute. What's your best advice for people with this news for California?
Hire a really good attorney.
Okay. All right. Do you work with folks that are going through a divorce to help them in any way, or do you have to defer all that to an attorney?
Because I'm not an attorney, I'm not allowed to give any legal advice. I can advise them on the tax consequences of such situations. Okay,
gotcha. All right. Well, I appreciate it. Is there any other changes to the tax law that I didn't ask you about that you feel is important to convey to our audience before we sign off?
I think one of the biggest changes that I'm really excited about for business owners, self-employed individuals, is what's called the qualified business income deduction, or what they're calling it the QBI deduction, and some people are calling it 199 cap A deduction, because the code section it's governed by. So what that means is that if you're a business owner, so if you are a sole proprietor, or if you own S corporation, an LLC, a partnership, that up to 20% up to 20% deduction will be given on the personal level. So it's not going to be taken on the business return. It will be a deduction on your 1040. And what they're proposing right now is that it's not going to reduce your adjusted gross income, which is the number a lot of lenders look at, but it will be reducing your taxable income. So let's just say you have a sole proprietorship, you file a Schedule C every year, you have $100,000 worth of income, you get a 20% deduction off your taxable income, which is significant.
Yes.
Yeah, so something to keep in mind with that is that it does reduce taxable income only. It does not reduce your self-employment tax.
Oh.
Yeah.
Well, at least there's some good news in there.
Yes.
Well, I really appreciate you coming on the show and helping explain this, because I think a lot of people are in the dark about this. And I know tax and 1031 exchange is kind of a dry topic, but when you're in business for yourself, or you're in going through something in your life or with your job that this affects, it's important to know this. So
Absolutely.
appreciate you sharing your time and your expertise with our audience too. And
Welcome.
if people want to get more information, because I know we threw a lot of technical terms at them, what's the best way to reach out to you?
Same thing. You can call, email, or go through our website. It's elmtax.com. That's elm like the tree.
All right. Well, thank you very much. And you enjoy your 3-day Memorial Day weekend, and look forward to having you back on the show at a later date, because we want to keep people up to date on these tax changes and how they affect them as business owners and as employees.
Thank you so much, Thomas. It was really great today. Thanks.
All right. Take care. Bye-bye.
Bye.